Hello, you magnificent people. Yes, I'm talking to you. The curious, the thinkers, the ones who want to know what's really going on behind the scenes of your daily life. Whether you're sipping coffee at home, hustling at work, or just scrolling through your feed, you're about to discover something that affects you more than you might realize. Today we're diving into a topic that touches every single one of us, whether we notice it or not. Banks. Not just any banks, but the big ones. The ones that shape the world economy. Welcome back to the show, where we break down the complex world of money and power into something you can actually use. Before we get started, do us a quick favor, hit that subscribe button. It's a small click for you, but a giant leap for our channel. It helps us keep bringing you the stories that matter, and trust me, you don't want to miss what's coming up. Now let's talk about something that quietly, almost invisibly, runs your entire life. Central banks. These aren't just regular banks where you stash your paycheck or get a loan. No, these are the puppet masters of the financial world. I know, just hearing the words central bank might make your eyes glaze over. Maybe you're already thinking about skipping ahead, but trust me, stick around, because this is where the real action happens. These financial wizards in their sharp suits are the reason you can, or sometimes can't, afford that shiny new car you've been eyeing, why your mortgage payment suddenly changes, and even why your favorite pizza place is hiring more staff or cutting back. Their decisions ripple out, touching every corner of your life, from your job to your weekend plans. They pull the strings that affect your job security, your savings account, and the price tags you see at the grocery store. Every dollar you spend, every bill you pay, is influenced by the choices these institutions make. Imagine the economy as a giant, unpredictable car. Sometimes it's speeding along smoothly. Other times it overheats or stalls out on the side of the road. When things go wrong, who do we call? The central bank is like the master mechanic stepping in with mysterious tools and techniques, things like quantitative easing and the federal funds rate. These might sound like complicated jargon, but they're the wrenches and screwdrivers that keep the economic engine running. It all sounds like a lot of red tape and technical talk, but don't worry. Tonight, we're going to slice right through the confusion and make sense of it all. Stick with me as we sneak backstage, past the velvet ropes and security doors, into the very heart of the financial system. We'll see what really goes on behind those closed doors. By the end of this episode, you'll be able to decode the secret language of these economic overlords. You'll understand what's really happening when you hear about interest rates, inflation, and all those other buzzwords on the news. You'll finally know what those interest rate hikes on the news actually mean for your wallet, your job, and your future. This is the stuff that truly matters, even if it's dressed up in the world's most boring clothes. So grab a snack, get comfortable, and let's pull back the curtain on the real power behind your money. So, what exactly is a central bank? You might have heard the term on the news or read about it in the business section, but it's not always clear what these institutions actually do, or why they matter so much to your daily life. First, let's clear up a common misconception. A central bank isn't your neighborhood bank with a friendly teller who greets you by name and helps you deposit your paycheck. In fact, you can't just walk in and open a checking or savings account there. Central banks don't serve regular customers like you and me. Instead, think of the central bank as the bank for all the other banks, the financial system's mothership, quietly steering the ship from behind the scenes. Every commercial bank you use, from the biggest national chains to the smallest local branches, has an account at the central bank. It's where they settle their own debts and manage their reserves. But unlike regular banks, the central bank's main job isn't to make a profit. Its real mission is to keep the country's economy stable, healthy, and growing over time. Central banks have two big, sometimes competing goals: keep prices stable, meaning fight inflation so your money doesn't lose value, and help the economy reach maximum employment so as many people as possible have jobs. But here's the tricky part: these goals often pull in opposite directions. Trying to lower inflation can sometimes slow down job growth, and boosting employment can risk higher inflation. That's why the central bank is often compared to the economy's thermostat. It's constantly adjusting the temperature, trying to keep things just right. If the economy gets too hot, meaning prices are rising too fast, the central bank steps in to cool things down, often by raising interest rates or tightening the money supply. But if things get too cold, like during a recession, when people are losing jobs and businesses are struggling, the central bank acts to heat things up, making it easier to borrow and spend. It's a constant balancing act, a Goldilocks situation, where the goal is to keep the nation's finances not too hot, not too cold, but just right for steady growth. In the United States, this powerful institution is called the Federal Reserve, or simply, the Fed. In Europe, it's the European Central Bank, which manages the euro and monetary policy for many countries. In the United Kingdom, it's the Bank of England, one of the oldest central banks in the world. Most countries have their own central bank, and these institutions are designed to be independent from day-to-day political pressures so they can make tough decisions for the long-term good of the economy. The idea is simple: let trained economists and financial experts, not politicians, make the crucial calls about interest rates, money supply, and financial stability. Of course, whether central banks are truly independent, or whether they always get it right, is a hot topic for debate among experts and the public alike. For now, just remember, central banks are the powerful, supposedly impartial managers of the economy, making decisions that affect everything from your mortgage rate to the price of groceries. They set the rules of the financial game, shaping the environment in which banks, businesses, and individuals operate, and their decisions send ripples through every part of your life, whether you notice it or not, from the job market to your savings account, and even the cost of your morning coffee. Have you ever wondered how the central bank manages to keep the economy running smoothly, almost like adjusting the temperature in a room? The answer lies in a powerful tool that affects nearly every aspect of our financial lives. Their main tool, the interest rate, acts like a thermostat for the economy, turning the heat up or down as needed. An interest rate is simply the cost you pay to borrow money, or the reward you earn for saving it. It's a small percentage, but it has a huge impact on what you can afford. The central bank sets what's called a benchmark rate. This isn't the rate you see on your credit card statement, but it's the foundation that influences all other interest rates in the economy, from mortgages to business loans. This benchmark is the rate at which banks lend money to each other, or borrow directly from the central bank itself. It's like the starting point for the entire financial system. When the central bank raises this rate, it becomes more expensive for banks to get money. In turn, they pass those higher costs on to you and me, making loans for homes, cars, and businesses more costly. Higher interest rates mean that monthly payments on mortgages, car loans, and even credit cards go up. This discourages people and businesses from borrowing and spending. As borrowing slows down, spending drops, and the economy cools off. This is one of the main ways the central bank fights inflation. By making it harder to borrow and spend, prices are kept in check. But what if the economy is sluggish and people aren't spending enough? That's when the central bank steps in and cuts interest rates, making it cheaper to borrow money. Lower rates mean more people can afford to buy homes, businesses are more likely to invest and expand, and new jobs are created. The economy gets a boost, and growth picks up speed. In this way, the central bank can hit the gas pedal, encouraging more spending, investment, and overall economic activity. But it's a delicate balancing act. If rates are too high, growth can stall, and unemployment can rise. If they're too low for too long, inflation can spiral out of control. Every time the central bank changes rates, it sets off a chain reaction like dominoes falling, affecting everything from the price of groceries to the value of your savings. That's why interest rate decisions make headlines and why financial markets react so strongly. These changes touch every corner of the economy. It's not just about abstract numbers or financial jargon. Interest rates affect your wallet, your job prospects, your ability to buy a home, and even your plans for the future. And it all starts with a single decision, made behind the doors of a very serious-looking building, one that holds the power to shape the entire economy. Interest rates are the central bank's main weapon, but what if that's not enough? Enter quantitative easing, or QE, the central bank's big gun. QE means creating digital money to buy government bonds from banks, flooding the system with cash. This pushes down long-term interest rates even further, making mortgages and business loans cheaper. It's like a double espresso shot for the economy, but there's a risk too much new money can cause runaway inflation. QE is powerful, but dangerous, like using dynamite to open a pickle jar. It's a last resort when the usual tools aren't enough. So, how does all this affect you? When the Fed raises rates, your credit card and mortgage get more expensive. If you're job hunting, high rates can mean fewer opportunities. Businesses borrow and hire less. When rates are low, borrowing is cheaper. Businesses daily life. That's why it matters. Here's the tricky part. The central bank's two goals, low inflation and low unemployment, often clash. When unemployment is low, wages rise, and so do prices, inflation. If the economy is booming, the central bank may raise rates to cool things down, even if it means some job losses. It's a tough trade-off, a little pain now to avoid a lot of pain later. This balancing act is called the Phillips curve. The central bank walks a tightrope, trying to keep the economy growing without letting inflation spiral. Raise rates, and people get angry about lost jobs or pricier loans. Cut rates, and savers get angry as inflation eats away at their money. There's no perfect answer, just constant adjustment. The goal: keep the economy just right. It's a thankless, high-stakes job. Every move is scrutinized, and the consequences are real for millions. Let's make this real. Think back to the 2008 financial crisis. The global economy was in freefall. Banks stopped lending, businesses froze, millions lost jobs, central banks slashed interest rates to zero, making borrowing as cheap as possible. But fear was so high it wasn't enough. So, the Fed unleashed quantitative easing, creating trillions in new money to buy government bonds. This flooded banks with cash, pushed mortgage rates to historic lows, and tried to jumpstart lending. The goal: stabilize the housing market and restore confidence. It was a massive, unprecedented experiment. Did it work? Most economists say it likely prevented a second Great Depression. Central banks acted as the economy's emergency service. Their actions didn't fix everything, but they stopped the bleeding. It was a dramatic reminder of their power, and why their decisions matter to all of us. So why should you care? Because the central bank shapes your financial future. Their decisions affect your ability to buy a house, get a job, and save for retirement. Understanding central banks helps you decode the news and make smarter financial choices. The health of the economy determines what governments can provide. Schools, roads, hospitals. A well-managed central bank creates prosperity. A poorly managed one can lead to chaos. The central bank is the silent partner in your financial life. Paying attention isn't just for economists, it's for everyone. To recap, central banks aren't normal banks. They're the economy's overseers. Their job is a constant balancing act, keeping people employed and money stable. Their main tools are interest rates and, in emergencies, quantitative easing. These decisions affect your wallet, your job, and your future. A competent central bank is the steady hand guiding the economy. Without it, we'd face chaos and uncertainty.